on that next round of funding. While that may be important for your journey, but somewhere, suppose you have raised a round and which gives you a visibility of say 18 months of runway, somewhere midway, you should look at how to extend that. So that is where revenue and things like how do you manage your money. For example, if there's two founders, one is technology, one is business, the technology founder will not like to let go of the technology team. The business founder will not like to let go of the business, sales and stuff like that. While both are important, and if you are at a stage where product is developed, there's product is never 100% developed, right? But if PMF is found, product market fit, and you are able to generate some revenue, and you see that the money is available for next 9 months, should look at how to extend it to 15 months. That is very important because today the funding journeys are becoming longer. Fortunately, we do seem to be coming out of the funding winter, so-called funding winter, which started in 22 sometime and went on till 24. But last 6 months we have seen that there is a change, especially in the early stage. Also in the late stage, but more so in the early stage, where the investments, the investment numbers are going up, but not so much. People, after the the pandemic, triggered boom in the startup ecosystem, funding ecosystem, and high valuations, people put a lot of money. So people are now careful because they have that experience. So today, whether it's valuations, or whether it is the quantum of money, the sector is very important. So we, being a deep tech focused fund, certainly we look at deep tech very closely. And within deep tech, we are sector agnostic as such, but we do have focus areas. And how many of you are deep tech founders here? So I see a couple of hands. But that doesn't mean that, that's the only thing. That is because the way things have evolved, especially last couple of years, with the government's focus, the global focus in areas like AI, space tech, robotics, and also interestingly, a lot of good work is happening in Indian institutions, driven by Indian Institute of Science, IIT Madras, IIT Bombay, and so many others. But surprisingly, there's very good work happening even in some of the state level institutions. Like I was in Odisha at KI, this Kalinga Institute of Technology. I was amazed to see the facilities they have and the kind of support they are providing to the startups in the technology space. So for technology startups, it's very important to work with incubators and accelerators to get access to support beyond money, right? Money is only one part of it, because a lot of times you may not get that kind of infrastructure, where you can't actually buy some of this stuff. The money required is huge. To access to some of these labs and facilities is very important. Like today, the EV ecosystem is evolving very fast. And if you are a battery tech startup, some of these labs and technologies you can apply for yourself till you have come to some scale. Now, for example, Indian Institute of Madras, Technology Madras, they have a cell manufacturing facility. If you have a cell technology, you can go and work with them and do that initial development. But from a pure funding journey for any startup, one thing which I would like to say is don't look at funding as a necessity. See, there are these deep technology startups which take a longer journey to develop their product. Their money becomes very important. Where there is a lot of money available from the government ecosystem and the institutions ecosystem to support them in the initial stages. But not for every kind of startups, right? Unless you are doing something very innovative. For example, in medtech, there's BIRAC. in many other technologies, there's DST support. There's Startup India Seed Fund, which kind of covers wider areas. So there is today money available in India from very early on in the journey. Sometimes a lot of us don't know about it. You know, for example, DST has probably supported over the years with small sums of money, but which is very critical at this stage. I sit on a couple of ICs where DST has funded this incubators and accelerators. These are largely linked to some institutions. This will not be private accelerators. These are largely linked to some institutions where they give you that initial seed capital to try out your, idea where you have some expertise. Starting from there, you do get scale-up capital again. Again from some of these institutions, then there are certain funds which start very early, right? You have idea stage funds, you have funds which are ready to give you some early capital. Today in India, we have 1,000 plus funds, in the VC ecosystem. Out of that, at least 300 to 400 are active. And some of these are angel funds. These are networks which turned into angel funds. We have heard names like Indian Angel Network and Mumbai Angel and Venture Catalyst and IPV. So many of them. But there are many others who are in different parts of the country. And fortunately, there is a lot of focus even in tier 2 and tier 3 cities. I work very closely with the state of Kerala. Government of Kerala is an investor with us, so I engage closely with the ecosystem there. There's something like Malabar Angels in North Kerala, though they're not specific to investing there, but they have a focus on Kerala. Similarly, there is an angel network in Kochi, and there are many others. So, across states, there's Utkal Angels in Odisha. There is a Bhopal Angel Network in Bhopal. And, we have then Thai chapters today. I think they've been growing quite extensively in India. And we probably have 12 or 15. 4 of them in Karnataka. So I'm sure there are about 15 in India. And each Thai chapter has now some kind of an angel grouping. It may be a formal one or a bit of an informal one. So money is available for the right opportunity. Now sometimes I meet founders, they say, people only talk but they don't give money. Now that is, I understand the frustration, but sometimes it is important to also look inward. Are we in the right business? Why is the investor not looking at your business positively? I have actually a full, session I have done on what do investors look for. Maybe I can share with you, Kishore, or do a web thing on that, which is like a presentation. But, it is very important to understand as a startup or as a founder, what do investors look for? And when I say investors, at every stage, whether it's angel, whether it is venture, or whether it is later stage, the P. Every opportunity may not be venture fundable. There's nothing wrong with what business you are doing. You may be in the right business. For example, say you have developed a consumer product. Now, say it's a product in the, what is very popular these days, in the beauty space. Number of startups have come up there. Though it's not a focus area for me, but I do look at some of them. Now, some are really doing very innovative work where they have developed some new formulation which will create a new impact. But then there are many who just copy something, right? Ayurvedic formulation. There are a lot of Ayurvedic formulations available. Now you feel that you have done something innovative, but as an investor, I feel, there are many people doing this. For you to reach that 5-10 lakh revenue is easy, but the challenge is the next level. Now, if you burn a lot of capital to reach that next level, problem is, you will, sometimes there is the risk of, getting stagnated at a certain level. So it is important to understand, is this what you are doing? Is there a huge gap available? Or you are doing one more, variation of what is already there? Many players are there. So identifying the gap is very important. And that is where the investor will look at. Otherwise, you can look at some money. There's so much debt available in the market today, even collateral-free debt. As women founders, as SME, there's so much of collateral-free debt, and you don't have to go to venture capital or angel investor. So technically, angel investor can invest anywhere. If they like your business, they can invest. But venture investor looks at it very different. Also, when you approach a venture investor, it is very important to identify who is the right venture investor for you. For example, I have a certain focus, and if a D2C guy comes and approaches me, it's a waste of time for both of us, right? Well, I don't have that focus. I don't invest in D2C. So identifying who is your target VC, who will invest in that area, that stage, and that market. So that's very important when you approach any of the VC, and sometimes it is useful to find a connect, right? See, many of us get many such requests, right? People send us emails, people connect with us on LinkedIn. Sometimes, and VCs work with very limited number of people. Unfortunately, though VCs may have a lot of money to invest, but they have very limited money to manage their own work, right? Because there is only a small amount of management fee available for VCs to manage their day-to-day affairs. And compliance is a very big part of what a VC does. VC is responsible for somebody else's money. Imagine your own money, you are careful, but when you are managing somebody else's money, that the factor of carefulness goes up many notches, right? Clinics, different focus areas, because we still have a long way to go. Then the ancillary, like insurance. In a lot of these areas, technology in insurance. Like yesterday, there was a company talking about technology in trucks and buses, which will monitor driver behavior and stuff like that. It's not new, but there's a lot of evolution which has happened there. And today, insurance companies are actually talking about. One of the persons on the panel was a senior guy from Toyota. He mentioned that there's now technology Toyota is inbuilding which will kind of capture driving behavior, which will be linked to insurance. So there's a lot of opportunity in these ancillary areas which can become very big. So do look out for such opportunities. Even in your areas where you are already doing something, there's a scope for doing a lot more new stuff. Technology is going to be an important play, whichever area you are in. Unless you are at the forefront of technology, even if you are in direct to consumer, you will have to, make solid use of technology. You will have to do R&D if you want to be part of the startup ecosystem. If you want to be a regular business, nothing wrong with it. That can be scaled also. Today the SME ecosystem has grown drastically. The SME IPO ecosystem is growing, but we have to be, careful. So I hope I have given you some thoughts, some food for thought. I did not come prepared, so I was all over, but I hope it was useful. If you have any questions, happy to take a couple of questions, and all the best.
We were planning to interview all the startups in the post-lunch meeting, so in the Q&A on that. Any questions?
Any questions related to the funding ecosystem, anything, happy to take that. Or we can chat later. Anyway, I'm always available.
He's part of the ecosystem, so you can always approach him. I take the liberty to share that.
We can have a chat some other time when they are better prepared. Thank you.
So one, just a general question. You said that you have to be prepared for funding. You have to know which funder to go to. From the funder's perspective, are they more looking at startups or they are okay with the growth kind of a scenario? I mean, how do funders look at a business?
Every fund has a thesis, right? For example, if you are a business in the growth phase, there are funds for that. There are different funds who will invest. For example, we are an early stage fund, but there are funds who invest in growth stage. There are funds who kind of invest across stages. There are funds who invest across stages. A good example is some of these big guys like Sequoia and all. They invest across stages. They come in very early to coming in very late. And they are focused funds. And today all this is not very difficult. This data is all available. Today with the age of technology, you can ask AI, probably will tell you, which are the funds in India, registered funds in India, which are say focused in direct to consumer or electric mobility and transportation, logistics. So many sector specific funds have also come up and sector agnostic funds, but they generally have a focus around broad areas. Today money is really not a problem if you are doing something which is catchy, which is innovative, which is making a difference. So that is why it is important to also understand what are you doing. Sometimes as founders we miss that. We feel what I am doing is the best. And yesterday we did say this. These are the finalists in a program where 100K is being given, where we felt, they were in the Me Too kind of business and there may not be enough scope. And there were others who were doing such innovative stuff. They may fail, but it was worth a try. For example, a startup was, I don't know if any of you have heard, it is like a fuel pump for battery cells. So not battery swapping, cell swapping. So you go to a pump like this and you plug in whatever, not a charger, whatever, a cable, and cells are taken out of your battery and new cells, charged cells are replaced. So ultimately the charge is in the cell. And for me it was in a deep tech focused fund, I had not heard of anybody doing this. Then I am sure there are a lot of challenges. It is not that it is successful today. But the fact, and I thought it was just an idea. I was telling him, let's move to the actual, what have we done? And he actually has done it. It is, the POC is done. The hardware is, already done, tested. For me it was something, I may have missed it. Maybe it is something happening globally in one or two places. Now this guy said he's the only one. And I kind of tend to at least believe that, yes, because we have not heard of something like this. So that is very disruptive. And a lot of times you don't have to know everything in technology. That is where you will have to build a team.